One sector critical to the nation's ambition to be a digital economy is the FinTech sector, and its growth through the pandemic has been critical to the economic recovery. It's employing thousands of Australians already and growing rapidly. It's also transforming the way we manage, save, and spend money. Australia's largest emerging companies are FinTechs, and they are drawing overseas investment into the country. Many, like Afterpay, Zip, and Upbank, are household names. But crucially, they are helping everyday Australians get smarter with their money. They are teaching them how to save, plan, and capitalize on every dollar they earn. FinTech is slowly but surely changing the way we think about money in Australia. Not only is it directly contributing to our economy, but it's making it stronger. Here at Intersect, we're discussing this future and asking the big questions. We'll be hearing insights from new voices in the sector and giving a platform to some of the behind-the-scenes talent that have put Australia's FinTech industry on the map. So sit back and enjoy Australia's most thought-provoking conference, Intersect.
Welcome to our webinar on the recent FinTech fundraising and exit deals, assessing trends and opportunities, run by DLA Piper, which is a part of Intersect's digital program run and hosted by FinTech Australia. My name is Rebecca and I am the CEO of FinTech Australia. The digital program is an opportunity to extend our reach, showcase the latest FinTech trends, policy developments, or companies at the forefront of new technologies or products for those individuals that cannot attend the physical event or purchase a virtual ticket. We'd like to take this opportunity to thank our major sponsors, the Victorian Government, Austrade, Xero, BPay, and Data Action. The Victorian Government, I would also like to thank our digital sponsors, Maneuver, BDO, Argyle, and Q2. I would now like to introduce you to our presenters today, Dylan Burke, Special Counsel at DLA Piper, and Joel Cox, Partner at DLA Piper. Thank you again for participating in our digital event series, and I'll now hand over to our presenters.
Thanks, Rebecca, and congratulations to you and the Intersect team on the conference that's coming ahead this week. It looks excellent, and we're really excited to be involved. So thanks everyone for joining. I see we've got a good list. It looks like quite a few founders and quite a few people who are working in FinTechs. So great to have you on board. As Rebecca said, the objective today is to share our insights, both from our global colleagues and from our work here in Australia on where money is flowing in the FinTech sector and where we see good opportunities, and how, in our opinion, FinTechs should best execute on capital raising and exit deals in the current climate. So Dylan's going to walk us through some perspectives. I'll chip in with some oversight over top. I think probably just at the outset, if we could have you each just put in the comment chat something you'd like to get out of the session or a particular topic you'd like us to focus on, that'd be really useful so we can make sure that it's tailored for the audience. So please be forward in prompting us with suggestions. We've got an hour, I think, and we'd love to specifically engage with you on what's most relevant to you. So please start putting in some comments, and while we're waiting for them, I'll hand over to Dylan.
Great, thanks Joel, and lovely to meet everyone virtually. My name's Dylan Burke. I'm a Special Counsel in the corporate team here in DLA Piper Melbourne. So I work for a lot of technology companies and investors in them across M&A, fundraisings, venture capital, corporate structuring, ESOP advice, and so on. So as Joel mentioned, we've got quite a jam-packed agenda today. If we can move to the next slide, just worthwhile just giving a bit of a roadmap in terms of where we want to move on to today.
And can I just get the slides back on the sharing screen, Art? Or maybe they're there. Yeah, got it. Okay, there we go,
Yep,
Dylan.
that's working now.
Perfect.
Awesome.
So yeah, if we could just basically just set out a bit of a roadmap for what we want to achieve today. It's up on the screen there. We wanted to just do a quick roundup of the FinTech investment landscape in 2020. Just a quick overview and a recap of that. We've got quite a bit of PitchBook data that stands behind that, and we can drill into the detail in that regard. But then after that, we'd really like to drill into more of the hot topics that we see in terms of our practice here in Australia and beyond, where we see the favourable conditions for capital raising and exit deals, how we observe the current climate in terms of dynamics for deal making. Joel's going to talk to us about a few tips in terms of how to do a successful deal in this climate, and then to recap on a couple of other factors that might not necessarily be front of mind when you're thinking about FinTech investments and exits. And again, as Joel said, if there's anything that you want us to cover specifically, please do feel free to put comments into the chat facility, which I see is starting to already.
Yeah, we're
hot,
getting
so
a
that's
few,
great.
so we'll come back to them.
Excellent. So if we can move on to the next slide, as I mentioned at the outset, we've got quite a lot of data here from PitchBook, which I'm sure most people on the call will be familiar with. And it's really interesting data, but anyone who's read a PitchBook report will know that there is so much data in there, and we don't propose to necessarily do a deep dive on each and every stat because we'll probably exceed, we'll definitely well and truly exceed the time allocated. But if I could just touch on a few high points. As you can see on the screen there, there's been a real market increase from 2015 and beyond in terms of the value of deals that are happening in the US in FinTech. You'll see up on the screen there that we are differentiating between angel and seed, early VC and late VC. And just for background purposes, angel is where there's no PE. This is all PitchBook definitions, by the way. Angel is where there's no PE or VC investment mentioned in any press release, and or where the press release in relation to the transaction specifically mentions it as an angel transaction or as angel involvement. Seed, again, is where the press release refers to it as a seed transaction and or whether it's 500K or less. Early VC, Series A and B, and late VC, Series C, D and beyond. So you'll see there that the graph is showing a general trajectory up towards where we currently are in 2020. And if we look at some of the specific data, Q4 2020, FinTech companies raised 12.3 billion across 647 deals. And Q on Q, that was an increase. Depending on which way you cut the data, you might be looking at an increase in value across quarter to quarter, or a decrease, and deal count quarter to quarter, or you might be looking at a decrease in deal count year on year, which we'll come to shortly. But the overall trajectory is up. And you'll see on the screen there, if you segment the analysis there between early VC and late VC, you'll see that there's a real shift towards late VC as taking up a lot of the deals by value, which is an interesting stat that we'll unpack as the slides go on. And again, just another point to pick up on the right-hand side of the screen there, payments is really where a lot of the largest deal value is coming through, which is the case in the US, and I think we'll unpack this a bit later. That's really consistent with our experience here in Australia as well.
Yeah, and I guess it's worth just touching on, we don't have the same data available in Australia, but roughly our view is that the VC market here is worth $2 billion in comparison to 100 to 120 billion in the US. So you should be thinking about our VC market as roughly 2% of this. Now, with FinTech, it's a bit different because we see a lot of money that comes from ASX top 100 companies, and particularly from the top 4 banks. And quite a bit of that money isn't captured in the AIC or other venture or FinTech deal tracking. But, we'd roughly say the FinTech market per year is in the order of $500 million to $1 billion here in Australia. We're seeing similar trends to this, to what's happening in the US locally. And as Dylan will extrapolate on further, we're seeing strong activity in the second half of last year and in the first 4 months to date this year, at every stage, and particularly at seed and early VC, and then at pre-IPO and IPO deals, and in exit deals. And it's probably that last category where most of our work in FinTech has been focused over the past 12 months. We had 2 or 3 months following lockdown in March last year where we were doing a lot of emergency capital raising and a lot of small rounds for our FinTech clients from their existing shareholders, just because of all of the uncertainty that COVID brought. But quite quickly, from about late May onwards, our work flipped to the point where we were doing predominantly M&A deals and acting both for ASX 100 buy-side purchases of FinTech businesses, and then also acting on seller side a fair bit. And so that's what we'll talk to in a bit more detail. We see those trends continuing. So we see early stage money being available for the right businesses, and we see quite a bit of opportunity for tech M&A, and maybe for FinTechs to sell earlier than they might have otherwise thought about, if that's appealing to the founders and to the business model.
Thanks, Joel. If we move on to the next slide, again, there's quite a lot of data coming through these reports, and we don't necessarily want to unpack each and every single strand in that data, but again, it's showing the general theme is up, which is great. And as I mentioned before, depending on which way you slice and dice the data, you might be looking at a slight drop off in the deal count, as you see on that screen there. That's the year-on-year figures, moving down slightly, but on the flip side, there is an uptick in the deal value. So less deals being done for a greater value, which gives you a sense of the general trend in the US. In addition, we've got some data up on the screen there around the median pre-money valuation for VC-backed late-stage FinTech companies. And you'll see that there's been a huge increase, 66.5% to 135.5 million in 2020. And again, we've got some historical data on the screen there, which you can look through in terms of how the numbers have tracked over the years. And then just finally on this slide, valuation multiples is an interesting stat here around how they've tracked. So a slight uptick from 12.2 times a revenue multiple in 2019 up to 13.5 times revenue in 2020 as being the average metric there. And interestingly, PitchBook does point out that that's not actually the all-time high. The all-time high was achieved in 2015 and was a 16.3 times revenue multiple, which is interesting that that's come back slightly, and be good to hear people's thoughts on why that might be the case.
And Dylan, does it kind of extrapolate at what stage those multiples are applying?
That's across the board. Unfortunately, they don't really necessarily segment across the different stages of the VC life
because
cycle.
there is a general thought, and we speak to a lot of investment banks about valuation of FinTech, and it's really hard, and it's very much different to SaaS deals that we're doing a lot of and that are much easier to value and to pick out winners amongst, because you can apply the 40% rule in SaaS and really see what is a successful story. And we're not sure what is the equivalent to the 40% rule in SaaS for FinTechs, but there is a rule of thumb which people talk to us about and which we're starting to see, whereby valuation for the best FinTechs is in the range of 12 to 15 times revenue, or as high as 40 times EBITDA. And we are seeing deals being done in that way. And when we talk about exit trends and the fact that you may want to sell a bit earlier than you otherwise might have thought, they're when the deals are being done at that stage. But importantly, what we're seeing a lot of is, are being done at that valuation. But importantly, what we're seeing in almost every deal is a very large at-risk component at the purchase price, or earnout. And Dylan will speak to that a bit more. But those valuations are including the at-risk component when we're talking about 40 times revenue. So it's more complex than just simply thinking, you know, that you can multiply your 40 times EBITDA, that you can multiply your EBITDA or revenue by those amounts.
And it's really interesting to see how the dynamic plays out in terms of how the different sides of the table approach whether that is at risk or not. And I think it's pretty fair to say that throughout the course of 2020 and even into this year as well, a lot of founders are taking a very ambitious view in terms of whether that is an at-risk component or not, and essentially assuming that to be almost a sure bet. So there's quite a lot of confidence abounding in terms of these earn-out metrics. But if we move on to the next slide, I won't spend too long on the next slide, just really, again, to show some general themes and trajectories in terms of median fintech VC deal size and pre-money valuation. The really interesting point on this slide is that if you segment between angel seed and early VC, as distinct from late VC, you'll see that the angel seed and early VC graphs chart a much more predictable curve, whereas the late VC is really much more up and down. And I think one of the key take-home messages in that regard is that all it takes is for a handful or one or a handful of really big deals to skew the numbers. And we've all seen the big numbers that are coming out of the US on specific deals, and that really does have quite a disproportionately large impact on the numbers that we see.
So can we just to help us out and to let us tailor the presentation, can we just get a comment in the comment chat as to whether you're focused individually on seed, early VC or late VC? And so early VC roughly Series A and B, and then late VC Series C and onwards, or a pre-IPO deal. If you can just put comments in the chat, that'll allow us to tailor our thoughts. Yeah, I think just taking or giving an Australian perspective over top of this, I think the late VC's less prevalent here as a deal. And if you are doing a later VC deal, you're doing it with growth capital funds from the US almost exclusively, and in a very limited number of cases with growth capital from China. And so growth capital is $20 to $100 million checks. We act for a lot of US growth capital funds. And we've done a few interesting deals in fintech in the wealth space, for example, last year with our client UpData that invested in Practify. But predominantly we're doing deals in the SaaS space for those growth equity investors. The one thing to keep in mind about valuation always, particularly at angel and early VC, is, naturally you don't want the best valuation necessarily in a deal, and you're much more focused on getting the right partners. But it is useful to have this data as, as a sounding board and a means to compare.
Final slide on the pitch book data. Just wanted to, again, slice and dice the data in a different way. Next slide talks about the VC exits by stage. And you'll see on the screen there that they're segmenting between buyout, acquisition, and IPO. Buyout has largely tracked a fairly standard course over the years, albeit with some variances. But really the interesting part of that slide is really coming down to the split between acquisitions and IPOs. And if we look as far back as 2018, the IPO cut of that segment was really much greater. And that's come off somewhat in the last 2 years, which has really given way to the acquisition stream really eclipsing everything else. You'll see there that that's really achieving the lion's share in the 2020 data. And then finally, just on the VC deals, number of VC deals by region, again, just wanted to look at that in terms of the geographical perspective. And again, that's charting a pretty solid course over the years. You'll see the US or North America's at the top of those charts, and achieving probably the majority, and followed by Europe and Asia. And then you'll see down the bottom that light grey bar, which accounts for Oceania, which has really, again, charted a pretty standard course over the years. So again, that's probably consistent with our global insights in terms of the volume that we're seeing through the global network, and just worthwhile reflecting on that as well.
Yeah, and it's interesting how high the percentage of exits through IPOs are for fintechs. That's a fair bit higher than tech in general. It's probably roughly about 20% of SaaS companies that exit through an IPO. So it's an important point for all fintechs to keep in mind. And then it's interesting to see the lower buyout percentage. And someone did indicate they're interested in private equity and a buyout deal in the next 12 to 24 months as compared to an IPO, and trying to compare both. We certainly see less buyout deals and less of those growth equity investments that I was talking about into fintech as compared to SaaS. But our sense is that it is increasing, that both local PE funds, so your likes of Pemba, Potentia, 5V, and a number of other local VCs are becoming more active in fintech. And then the tier one global private equity funds are very active, and we're particularly seeing them in payments deals in Europe, and in a whole array of fintech deals in the US. Yeah, and just, before we leave valuations, just touching on kind of some of the comments that have come through the comment chats, because a few of you have said you're really focused on seed stage deals. And in our opinion, the secret to a good seed stage deal is the composition of investors and the strategic support you get from their brand, or from having them involved. And one of the most important things in fintech deals locally, in our view, is when you decide to take money from a strategic, or if you decide to not take money from a strategic, you can do a deal with a big four bank, or one of their venture capital arms, or with another ASX listed company, or we have clients who are doing deals with UK and Canadian and US strategics all in the past 12 months. But it is important, depending on your business model and what you're seeking to achieve and how you're seeking to disrupt a particular sector in the next 5 to 10 years, that you think about what's the right timing for that. And there's no general rule. You really need to be specific to your business, in our opinion. And having a strategic investor can be a great value add in some instances. It can also be good to hold off and to bring them in later, and you create potentially a greater valuation or an option price that they pay later on. So they're both important to keep in mind. And so at seed stage, just focus on the composition of investors and getting the right support. And we can definitely discuss offline with anyone how you can do that, and give more perspectives. A couple of panelists have said they're interested in the pre-IPO space, and it's a space that we think's more relevant to fintech than other tech sectors, and we think particularly if you are focused on an Australian only play, or Australia and New Zealand only, or if that's your plan initially, it's really important to put the pre-IPO investors in the mix. We're seeing the pre-IPO investors do pre-IPO deals, which is interesting, which is roughly 2 to 4 years out from an IPO, whereas a pre-IPO deal is typically 12 to 18 months out from an IPO. And we're seeing a new range of investors who are just focused on those pre-IPOs and about helping founders to get ready for an IPO, but not necessarily forcing them to do it within 12 to 18 months. So I think one of our key messages as to how to run a good deal in this current environment is that you need to be multi-pronged in your strategy, and you need to, depending on where you're at in your life cycle, you need to be thinking about venture capital, growth capital, private equity, and an IPO exit. And of course, you need to be thinking about a trade sale exit eventually. And the key, and it's more important in this environment post-travel restrictions than ever, is you need to be meeting people under each stream when you don't need money. And our clients who've had the most success over the past couple of years had very strong relationships, and travel restrictions haven't had very strong relationships with investors, across a number of categories that we've discussed, or types of investors. And travel restrictions haven't impeded their ability to raise capital or to do an exit deal because they built that relationship over time. And so we just urge all fintechs locally to be really focused and disciplined in building strong relationships with each of the 5 categories we've spoken about. I think it's 5.
Yeah.
So one last point on the growth equity piece, and there's a comment here from there's a comment here that someone wanted to focus on B2B cross-border space. And it's a really good space that we like, and that UpData deal that I referred to earlier is a good example. If you've got a cross-border business model, if you've got a B2B business model, and the US is likely to be a key market, then that's where the growth investors will be most interested, the growth equity investors. So those people who are writing checks of 20 to 100 million, and they're people like our clients, Accel KKR, Level Equity, 5 Ounce Capital, and UpData Partners. But there's many others as well who are doing those deals. And so it's particularly relevant where you've got a B2B play and where you want support to execute on that US market expansion. Great.
One thing I would add to that analysis, I mean, you touched on, Joel, focus and discipline in terms of the multi-pronged approach and building relationships with all those categories. I think that focus and discipline point is really not to be underestimated. And deal fatigue is real in this space. We've seen time and again throughout the course of the last 12 months or so, founders really, probably get not necessarily approaching burnout, but just certainly that deal fatigue setting in. And from our perspective, it's easy for us to talk about that strategy because this is what we do for a day job. But we do realise that founders are running a business as well and developing products and platforms and the like. And so often it helps to have a roadmap at the outset. And I think, Joel, you'll touch on working with good advisors and how they can really help add strategic value to the process and making sure that you can see the end goal in sight and working towards that in a strategic way.
Yeah, and particularly for an exit deal, we urge our clients, you absolutely need, almost in all instances, a corporate advisor or an investment bank involved. And even most of our exit deals, we've done some good ones in the last kind of 3 or 4 months. And in this climate, our FinTech and our SaaS clients are generally being sold to the natural acquirer who the founders have maybe known for 2 or 3 years. And the inclination of a founder is, I don't want to pay 2 or 3% of the purchase price and a minimum cost of 500,000 for an investment bank to be supporting me on the sale, which is generally where fees are. There will be some flex because, you know, I already know the buyer and you know, it should be easy to execute on. But even in that scenario, we find that a good corporate advisor, they'll make their 500,000 by justifying your value and increasing the value with the obvious purchaser. But they will also de-risk the process. And so what the corporate advisor does, as independent to the lawyers, is they create a streamlined best practice sale process so that a buyer so it's transparent with a buyer and there's a lot of trust, and a buyer has confidence to put forward their best and final offer. And that's what is crucial in a well-done exit deal. As lawyers, we support that process, but it's ultimately a corporate advisor who, if done well, will create a quick, transparent and confidence building process for that natural acquirer. And they'll also give your shareholders comfort that they're getting fair value for their buck, and the founders have for their investment, and the founders have followed due process to test that. In comparison, if you're doing a capital raising, it needs to be founder-led in our view. And we don't see a role for a corporate advisor, certainly at seed or early VC stage. And most of our VC investors and even growth equity investors like to deal directly with founders and not with a bank that's taking a chip of the VC or growth equity investment. They want to know that founders are capable of running that capital raising process, but they also want to know the visionary nature of the founder, the strategy of the founders in a fair bit of detail, and the people qualities of the founder. And so that's why when you're raising capital at an earlier stage, in our view, it's important that it's founder-led. And you use advisors, and primarily it's a law firm like us, and there's plenty of other good law firms in Australia as well, in the background to ensure that you still get a customary and transparent process for the capital raising. There's one clarification question here, Dylan. Just can you clarify the implication of being New Zealand only focused? And look, the key issue for FinTech, and you know, it's a key issue in any venture capital or growth equity raising, is around TAM, or total addressable market. And so investors want confidence that they can get at least 10 times their money back. And they want confidence that founders, you know, if they're raising at seed or early VC, that they're in the game for 8 to 12 years, which is the average time that it takes to grow a startup to exit, and that they want to protect against the beach beamer, the beach house and beamer mentality that, you know, naturally we all have, whereby, you know, if we can get $5 million and buy a beach house and a BMW, then, you know, maybe that's a good outcome and we'll pull up stops. So if your FinTech is only focused on Australia and New Zealand, that can be very appealing to investors because it's much easier to execute on. But you just need to make sure that the total addressable market is significant enough to get the return that your investor wants. And the best deals and the best partnerships that we see formed with investors at all stages, where there's a clear meeting of the minds on what that TAM is and what the return on the deal needs to be for the investor before a term sheet is signed. And so it's not at all a negative if you're just focused on Australia and New Zealand. And as I said, it's great often in FinTech. But you just need to make sure the TAM and the size of return makes sense for you personally as a founder and for your investors. So hopefully that makes sense to answer that question, but give us a follow-up if you need more clarification.
Why don't we start to drill into a little bit more around the deal structuring side of things? And if we move to the next slide, we'd just like to start to drill in, as I said, into the deal structuring and what we're seeing in terms of trends in the market. And it's probably a good segue into the next batch of data that we're using here. And this is DLA Piper data. So we every year produce an M&A intelligence report. So we have the privilege of having advised on more M&A transactions globally than any other law firm for the past 11 years. And rather than being a shameless self-promotion / a plug, that's more of a way of saying that we have a unique insight in terms of deal data that we pull across thousands of deals across the globe. And it allows us to look at every single way you could potentially look at an M&A transaction. What is the purchase price? How much? When is it paid? In what form is it paid? What does warranty and limitation of liability provisions look like? Any way you could slice and dice an M&A deal, chances are our report has considered it. And some of the data we're just about to share now, we'll go into detail in terms of what we're seeing in the FinTech space particularly. As I said, we produce this report every year, but after our 2019 report came out in the first couple of months of 2020, we quickly realised that it would not necessarily have the same currency as it would in any other year, given the global pandemic. And so we actually produced in March, April, May last year, we produced what we call a COVID-19 supplement, which allowed us to compare and contrast between the 2019 actual data and the actual data for the first few months of 2020. And one specific trend that we wanted to just unpack a little bit here is the use of the split between different types of transaction structure that we're seeing in the market. You see on the left-hand side is the pre-COVID-19 position, which shows an overwhelming majority of deals were being done in terms of a majority share acquisition. 72% of deals were a majority share acquisition. Then on the right-hand side, you'll see the post-COVID-19 position is really a much greater shift towards minority share acquisition. So they were up 87% in the first few months of 2020. I think that's really interesting for a lot of people on this call, given that a lot of people will be considering potentially selling down, potentially raising. It's all about a minority stake being acquired there. So that's relevant in that regard. If we move to the next slide, another specific trend that we just wanted to unpack a little bit was the use of earnouts. We've touched on this a little bit already in terms of how a seller will capitalise on the success of the business after completion and enjoy the profits of that business after completion. Some historical data on the left-hand side across 2017, 18 and 19, you'll see that earnout periods were historically much more geared towards a shorter period of less than or equal to 1 year. Whereas on the right-hand side, the bottom right of the screen there is showing how that dynamic has shifted in the post-COVID landscape towards much longer periods. So 35% of deals were done on the basis of an earnout period of more than 3 years, which is a pretty significant shift when you think about how long it takes to achieve these particular milestones. And again, we talked before about different dynamics between sellers and buyers. And interestingly, we saw some deals last year where sellers were given quite a long time to achieve some product milestones, and they've actually, really outperformed and achieved them in record time. So that 3-year period might not necessarily have any real connection to the actual outcome of a deal, but it is worth just exploring that is becoming a much longer period.
Have we got, sorry if I've missed it, have we got detail of what percentage of the purchase price is an earnout, or it's not quite there?
No, we don't have that.
Yeah, okay, that's fair enough. So look, I think where this is most relevant, this discussion, is around the fintech locally that's doing an exit deal to an ASX 100 company, or to those natural acquirers or strategic buyers. Like, you know, we had a Toronto Stock Exchange listed buyer by a fintech late last year. We had another company, Encino, buy a fintech in Melbourne. Encino, our client, just before it listed on NASDAQ, and did an awesome IPO. I haven't checked its trading price recently, but yeah, did a pretty amazing IPO through the course of last year. And it was really important to that client of ours that they bought this Melbourne-based fintech. So in a lot of these deals, particularly with ASX top 100 companies as the buyer, they're buying the fintech earlier than they might have otherwise in this climate. And vendors and institutional investors in fintechs were open to that, particularly last year. But there was always a bridge in the valuation expectations of sellers and buyers. And so the way that that's been overcome is through a much larger earnout in deals last year as compared to what we've ever seen in the space before. Initially, we're a bit hesitant around that, and around some of these deals, because a lot of the ability to control that earnout and performance against the earnout, is in the hands of the buyer and not the sellers. But we do think, and admittedly, we act on both buy and sell side on these deals. We do think you can design a regime where there's enough autonomy for founders, but the right governance and control for a buyer over execution to get a decent win-win position. And we think this is going to this will continue for the foreseeable future as a key feature in exit deals. And we think founders and institutional shareholders being open to the risk that comes with an earnout, but to the potential upside where they're structured well, makes good sense.
Yeah. I think if we could, I think there's one more slide on earnouts which goes into a little bit of detail in terms of the criteria that's that underpins those, and there's probably not too much by way of surprise in there, but particularly on the right hand side of the screen, what are the criteria that drive whether an earnout is satisfied, and if so, how much is payable? Again, overwhelming majority is tied to earnings, turnover. Interestingly, the specific event we started to see quite a lot more in 2020, as I mentioned before. Product development milestones and development of the underlying platform was one where we started to see a lot more interest in terms of how that earnout was structured. So we anticipate that specific event will probably go up as time goes on, but otherwise earnings and turnover seems to be the main one throughout the course of recent history. I think it would be worthwhile, as we mentioned at the outset, that we would talk about a few of the other factors that are relevant to the success of investments and exit transactions. And really, when we talk about other factors, it's probably more of those softer points. And so we'll come to culture in a moment. But if I could just, while I've got the floor, just touch a little bit on that second bullet point there, which is the involvement of the non-fintech players. And this is a theme that we saw really playing out in strong regard last year, where non-fintech players really started to differentiate their product offering and their service offering into fintech. And it's an interesting theme, because really where we see that playing out is players that are starting to really focus on a very small subset of the market. People on this call will be aware of fintechs that are really geared towards particular demographics, whether that be senior members of our community or children and young adults, or particular trade and industry focused fintechs. In addition to that, we are seeing the non-fintechs are really starting to differentiate outside of their core offering. And we saw some pretty strong examples of that last year, and we expect that will continue. Whether that will translate into what we've seen in the US and Europe, which is non-banks chasing banking licenses and the like, maybe we won't see that. And I mean, Joel, you might want to talk a little bit about neobanks and the history and the success or otherwise that they've had in Australia.
Yeah, I think we didn't do a lot of the neobank deals, and most of the fintech work we do, as I said, is acting for either companies who are raising from venture and growth equity or looking to do an IPO or pre-IPO round, or for companies who are at exit stage, or we're then or alternatively, we're advising venture capital funds or growth equity funds on their investments into fintech. And what's been crucial in virtually all of the deals we do is that there's a low cost of customer acquisition, that there's fixed costs in the business, and there's the ability to scale very quickly. So it's a typical venture capital business, backed business model. And so different to the neobanks who raised, hundreds of millions in capital to support their banking licenses. There's definitely been mixed success with those neobanking strategies. And we can't give too much insight on it because we weren't involved in those deals. But what we'd say is that there's a doubling down, and there's that increase in both amount of funds invested and the number of deals that are happening in the space where we are, in venture, growth equity, pre-IPO, IPO, and exit deals. So I think, as Dylan referred to, we're seeing more positive activity around businesses who are getting banking licenses in the US and the UK. And maybe that will come back in Australia. But, regardless of whether it does or not, we just think the money in these other streams and the opportunity and the support you can get from investors in these other streams will make for a lot of good opportunities for Australian fintech. And then the other point that Dylan was touching on, we've done quite a bit of work for local SaaS players like Xero, who Xero did a fintech deal last year, which you can look up. Of course, they've announced it publicly. We acted for a fintech that took money from a merchant in kind of the tradie space, we've seen names like Qantas and many other established industrial companies investing in fintech, and there's quite a few who are doing this not in the public arena as well. So we'd urge fintechs to think about both other fintechs and other financial services players, but also non-financial services players. And we do think locally the Afterpay effect is and the success of Afterpay and Zip is motivating people to look to alternative sources of revenue like financial services revenue. We also acted for Worldline last year, which acquired the merchant acquiring business of ANZ in an M&A deal, one of the largest fintech M&A deals last year. And that's another interesting trend whereby offshore fintechs, often who are private equity backed or they may be listed, are definitely quite interested and active in doing Australian M&A. And they see generally both US and European fintechs and SaaS companies see Australia together often with Japan and a few other markets as key areas of focus for M&A deals. Yeah. The last thing, just touching on one other deal we did last year, whereby a Danish-based startup purchased a startup here. It wasn't in the fintech space. It was roughly about a $20 million purchase price. But just an interesting deal, and I think it's relevant to fintech because we are seeing those European and US startups that have raised in the order of 50 to 100 million as wanting to do an acquisition deal here to get a beachhead in the Australian and New Zealand market. So if you're kind of at Series B stage and you're thinking that maybe an exit is more appealing than going around again on a capital raising, that's where a deal like that may be of interest. Not that we want to discourage the capital raising.
Yeah. And it's interesting you mentioned, offshore jurisdictions like Denmark, Japan, etc. Might be a good segue to talk about culture as just one final point before we maybe open up the floor to more questions. Do you want to touch on?
Yeah, I think as a general rule, we just think the cultural piece of both capital raising and finding good partners and of doing M&A in particular is really underplayed by all players in the market, and we're guilty of it ourselves. And we think if you can get a good cultural fit with an investor or a buyer, and you are confident they'll be a good custodian of your business, then that's generally where you'll get the best win-win outcome for everyone involved, and where a buyer will pay the most for your business. So yeah, we would just urge all of you, as you're thinking about how do you do a good deal in this environment, we've given quite a few tips, but definitely keep that cultural piece at front of mind, in our opinion. Just now, I'm conscious we've got, where are we at? We've
5 minutes to go.
Yeah, we've got 5 minutes. So we might have missed something. So it would be good if you can just upload a few questions through the chat line, and we can always come back to you offline if we don't get them now. I'm conscious someone did mention that they're a PE-backed company looking to IPO in next 12 to 24 months. And it's a good case study to think about because the first, and they mentioned they just wanted to know about a pre-IPO deal. The first thing I'd say to that situation is just what benefit do new investors in a pre-IPO deal bring over your current shareholders, and maybe taking a little bit more money from your private equity fund. And look, generally the reason our clients do pre-IPO deals is so they can accelerate growth and sophistication and be well prepared, not just for the IPO, but for the 5 years post-IPO. And so they take 12 to 18 months generally to refine their strategy. And generally our clients are not profitable. And so they're doing the pre-IPO deal to give them the 12 to 18 months more runway and the better profile when they list. But the other key reason why our clients typically do a pre-IPO is because, done well, the institutions that invest in a pre-IPO will double down at IPO, and you'll have a lot of your book for the IPO already filled, and you'll have had 18 months experience of them getting to know the business. So for that individual or company, we just keep in mind you really want to have strong strategic reasons to be doing that pre-IPO deal, because when you do it, you are you need to get liquidity, normally because it's done as a convertible note, but sometimes the pre-IPO deal is done as a participating liquidation preference. And it does force you to do an IPO or to pay out that investor with their minimum return. So the benefit of just taking money from your existing PE on the cap table is that you keep the optionality for a trade sale or an alternative path still open. So you don't want to lightly do that pre-IPO deal in our opinion. Okay, Dylan, just wrapping up, anything you wanted to?
If we just fast forward to the final slide, or the second last slide, possibly. Maybe one more.
Okay, we're just touching on that quickly. I mean, we're always keen to meet with fintechs, so feel free to call Dylan or I at any time, or any of our team. And you know, if we can give you some resources or a step up through a phone call or through our website, more than happy to do that naturally. Okay, which slide?
Yep, that one there. We've
Okay.
also got our open office hours sessions, which we run regularly, and I think we've got some slots in the upcoming couple of weeks. So if anyone has any specific issues that they want to drill down in further detail on, please do reach out to Joel or I, and we'd be happy to meet and discuss further. But otherwise, that's all the content that we wanted to run through today. Apologies if it was a bit of a whistle-stop tour. There is a lot of material, obviously, as you'd appreciate, in fintech, and then once you drill down into the investment trends and opportunities. But you know, it's a wide-ranging area that we see quite a lot of, and we see opportunities going forward. So it's really exciting, and we hope that everyone on this call enjoys that success going forward.
Great.
So thank you very much for your time.
Thanks all, and have a great conference, and many thanks to Beck and the team and Art for setting up. And yeah, great to be involved with such an impressive array of people who are presenting later this week. And on our side, many thanks to Amanda for setting things up internally here and for all your hard work. Thank you. Great. Have a great day. Cheers.
Thanks, guys.